Equity markets suffered steep losses today with the major indices across the North and the South America experiencing a broad-based sell-off amid the heightened investor anxiety. In the United States, the Dow Jones Industrial Average plummeted 2,231 points or 5.50%, closing at 38,314.86, while the S&P 500 dropped 5.97 to reach 5,000, and the tech-heavy Nasdaq also tumbled 5.82% to reach 15,500. Also, these sharp declines reflect growing concern over the combination of the factors including the inflationary pressures, interest rate uncertainty, and potential earning disappointments. The Russell 2000, which tracks the smaller cap companies, was also hit hard, falling to 4.37% to reach 1100. In the stark contrast, the CBOE, the volatility index, that is the VIX, often referred to the fear gauge, as also being surging 50.93 to reach 45.31, its highest spike in months. Also signaling a dramatic increase in the market volatility, the risk aversion, the investor appear to be rapidly shifting out of the equity and also into the safer assets or hedging their portfolios in anticipation for the further turbulence. Also, the sell-off extended beyond the United States border. The Canadian market were also deeply in the red, with the S&P TSX, also the composite index, falling to 4.69% and the S&P TSX 60 down to 4.44%, reflecting a widespread retreat from the risk across the sector, including the energy, finance, and the materials. The Latin America market also faced significant pressure. The Brazil Bovespa index sank nearly 2.96%, longing of the 3,800 points, while the Chile's S&P IPSA and the Mexico's S&P BMV IPC dropped 2.79% and 8.87% respectively. Today's market action underscores rising unease among investors who are grappling with the tightening of the fiscal conditions, geopolitical tensions, and the general loss of confidence in the near-term economic stability. Also, with the VIX sharply rising and the key global indices shedding billions in the market value, sentiments have clearly shifted into the defensive mode. The coming days will be critical in determining whether this is a short-term correction or the start of the deeper, more prolonged downturn. Commodity market reflected a day of divergence with a significant movement observed across energy, metal, and agricultural sectors. Energy commodities faced strong headwinds, leading to the day's losses. WTI crude oil also declined by 2.15% to settle at $60.66, while the Brent crude oil dropped 2.21% to reach $64.13. These declines come amid persistent concern about showing the global economic activity, reduced fuel demand, and the increasing inventories in the major consuming nations. Also, additionally, the geopolitical tensions and the uncertainty surrounding the OPEC Plus production strategies continue to weigh heavily on the investor sentiment in the energy space. Natural gas followed suit, slipping 1.64% to reach $3.7. Though still with a relatively stable range, it remains vulnerable to seasonal demand shift and fluctuating storage data. In contrast, the metal segment painted a more optimistic picture. Gold advanced 1.10% to reach $3,068, maintaining its strong position near the upper end of the 52-week range. Investors appeared to be rotating into the safe haven asset amid the mounting concern over the inflationary pressures, currency volatility, and the broader macroeconomic instability. Silver posted the strongest gain of the day among the tracked economies, that is jumping 4.57% to reach $30. The sharp rise may reflect increased industrial demand as well as renewed interest from the investors seeking diversification away from equity and fiat currencies. Agricultural commodities also showed resilience, with the soya bean inching up 1.07% to reach $9. The modest rise suggests continued global demand and potential supply constraint due to the weather-related disruption in the key growing regions. The commodity is hovering close to the higher end of its 52-week range, indicating relative strength in the agricultural sector. Overall, today's performance illustrates a clear contrast between the declining energy prices and the upward momentum seen in the metal and the agricultural sector. Market participants appear to be repositioning their portfolios in the anticipation of the economic shift, possibly favoring the hard assets and the essential over the cyclical commodities tied closely to growth and consumption. As volatility continues to define market dynamic, commodities will likely remain the focal point of the both hedging strategies and speculative plays in the day ahead.